Pre-qualified for $250,000. Pre-qualified for $550,000. Pre-qualified for $1 million? Wow. They must think I'm rich. Welcome to the Red Desk, your home away from the home you still haven't bought yet. Today, we're going to cover the difference between pre-qualifying for a loan and being pre-approved to get you one step closer to moving into your dream home. These letters, they're not fan mail, just a bunch of unsolicited pre-qualification notices from every bank and lender that's ever gotten a hold of my data. 99% of it, complete junk. Let's get this spam out of the way and dive right in. If you're confused about the difference between pre-qualifying for a loan and being pre-approved for a loan, you're not alone. They're the most frequently confused elements of the home buying process. It's simple. Pre-qualifying is a great way to get a sense of what you might be able to afford, but at the end of the day, it's more like a participation trophy. Most people can pre-qualify for something. You pre-qualify, you pre-qualify, you pre-qualify! I mean, honestly, my dog could pre-qualify if he had opposable thumbs and an actual income. All you gotta do is offer up your name, what you make, and your employment status, and a lender will provide you a range. The number you get back, it's a rough estimate. Don't get too excited. While it might be helpful to narrow down your search on Rocket Homes, it's not enough if you're serious about buying one. So you've pre-qualified, congrats, I guess. See, now it's time for the bit that actually matters. Welcome to the big leagues. Time to get pre-approved. The pre-approval process will give you a clearer picture of your financial health and how much house you can handle. This isn't some unsolicited estimate in the mail. It is exactly what you can borrow. A pre-approval requires a hard credit check to see how much debt you're carrying and your history of paying it down. So the less debt you have when applying for a loan, the better. Once you're pre-approved, sellers will take your offer more seriously. In fact, most sellers will require it. Okay, so now that you're pre-approved, you've got that mortgage, right? Not quite. Pre-approval is not a commitment to lend. The house you find still has to pass an appraisal to qualify. And because you often can't lock your rate until you find the property, the total amount and the estimated monthly payment are based on a hypothetical interest rate. I know. So many hypotheticals, but those are the rules. I don't make them. I just get paid to tell you about them. Now that we've got that off our chest, let's talk about how to sort out your pre-approval and help put you in the best position to buy a home. Here's what you need to do. First off, check your credit. You got a little crazy with your credit card in your 20s? Missed a few payments when you were backpacking in Europe? Me too. I can't even mention them. They are not safe for work. Unfortunately for me, and maybe you, lenders have minimum standards for your credit score. So if your credit stinks, you still have options, but that's a rabbit hole for another episode. Click that pop-up to check it out. Got some debt? Well, to the best of your ability, you should pay it off or pay down as much of that as you can. Your ability to qualify for various loan options is dependent on this thing called DTI, or debt to income ratio. DTI compares your monthly mortgage payments and your other debt payments to your gross monthly income. For the best chance of qualification, you want to keep your DTI below 50%. So let's say you take home $5,000 a month for gross income. If you've got $1,250 worth of debt you need to pay back every month, you're fine, even with all those avocado toasts. You've got a DTI of 25%. So congrats, you're on your way to securing a loan. You'll need to hand over proof of your income, your assets, and your debts. It can be a bit tedious, but the more information you provide, the better. Here is a handy list. The last step is comparing the rates you're offered. You'll notice that when you're shopping around, you'll see two, one higher than the other. The lower rate is the one your monthly payment is based on. The second rate factors the APR into the base rate plus other costs like mortgage insurance and closing fees. The bigger the difference between the rates, the more you're being charged in closing costs. But look, it's not just rates you should be worried about. All lenders have different policies and fee structures, so be sure to ask the following questions. Do they charge fees for mail-in or phone payments? Will they service your loan or sell it to another company? Will they reach out to you if there's an opportunity to get you into a lower rate? It's not nosy, it's your money. You gotta get a sense of how your mortgage will be handled after you sign on that dotted line. Okay, I know I said it before, but I really can't say this enough. If you want to buy a house, it is recommended you get pre-approved. This isn't about saving time, even though it saves a ton of it. The fact is, before even entertaining your offer, sellers and their agents want to make sure that the deal won't fall through, and that requires a pre-approval. Okay, so getting your paperwork sorted out will help you secure your dream home and move the process along faster. I mean, there are still plenty of other things that could hold up the process, like the appraisal, the inspection, and the title work, but at least the tedious paperwork will be out of the way. And there you have it, pre-approval complete, your first step toward homeownership. Hopefully you feel a bit more comfortable with the process, even if you haven't found your new home yet. Getting pre-approved allows you to act fast when you do find that home of your dreams. At the very least, don't be shy, apply. My friends at Rocket Mortgage will help you figure out exactly what you can afford.